Alright, today is Tuesday, March 9th, and this is a post-market recap for the stock market activities today. Big rebound day in the market, specifically for the beaten down, growth, and technology names. If you watched the episode I released during the weekend, we talked about the oversold conditions in a lot of the beaten down names, specifically in the Nasdaq, and that we are expecting a bounce in the short term. But I also showed you the contrast between the short term and the long term outlook from a technical perspective. In the short term, we had very severe oversold conditions in a lot of the names. In the long-term charts, the weekly and the monthly, the technicals are suggesting that the pain has just started, meaning that you're supposed to be tactical in your approach for this market. For example, if you bought puts or you shorted the market and you reaped the reward for the last couple of weeks, you should have been closing some of these positions and booking profits in anticipation of the bounce from the oversold conditions and perhaps playing some of those rebounds via buying call options. And I showed you an example of me buying call options in certain semiconductor names. And these names bounced big during today's activities, along with other oversold names. But you gotta keep your eyes on the big picture, that what we're seeing right now is a temporary bounce before we resume the primary theme of the sell-off of high-growth names and rotating to value names, so long as the current inflationary environment and the Fed response remains intact. What else was behind the massive bounce in the markets today beside the oversold conditions in the Nasdaq? Here it is. The Federal Reserve bought about $3.6 billion in Treasury coupons, specifically for the 7 to 20 years Treasuries. In addition, we had the 3-year note auction taking place today, and the results were better than expected, meaning that there was a lot of demand for the auction, pushing prices higher and yields lower. So today it was the perfect storm for yields to be hammered. And right away the algos are programmed to look at yields, and when we see yields diving lower, algos automatically start buying the Nasdaq. And this is exactly what we saw today. An algorithmic buying that took place overnight, and it was picked up by market participants throughout the day, specifically via call options buying. Now the question is, how sustainable is the bounce in the Nasdaq specifically? And to answer that question, the real question should be, how sustainable is the dip in Treasury yields? To answer that question, we have a slew of important economic data regarding inflation that we will receive tomorrow. So hold that thought in mind, because we will revisit the question during the conclusion of this video. But for now, I got a market to cover, and here we go. The Dow Industrial Average closing in the green by 30.30 points, or a gain of 0.10%. The Nasdaq closing in the green, big, by 464.66 points, or a gain of 3.69%. The S&P 500 in the green by 54.9 points, or a gain of 1.42%. And the big question here is, what about the bad closing for the Dow? Why did the Dow flush all the way down and closed at the lows of the day? Meanwhile, we saw the S&P 500 and the Nasdaq holding the gains. Remember, over the weekend we talked about the oversold conditions in the Nasdaq, and I talked about a rebound upcoming for the technology names. My anticipation was a rotation from last week's winners. We're talking about energy, financials, materials, industrials, into buying the dip in technology names. That happened to a certain extent today, but not in a notable way, meaning that we did not see a big rotation from one sector of the market to the other, and the bounce was pretty much algorithmic in nature. To answer the sustainability question of the bounce in the Nasdaq, one has to revisit the question of, are we about to see a rotation of profit taking, say from energy, and buying the dip in the Nasdaq? Number two, a sustainable recovery in any index, not just the Nasdaq, happens gradually, meaning that you start a bottoming process by consolidating perhaps going 1% up in a day, 1.5% back and forth, taking your time to solidify a bottoming process. A bottoming process does not work. For example, what we saw in Tesla today. The stock was down over 40% from the highs, and then it bounces higher by about 20% in one day. That tells you that we are still in the middle of the storm of volatility. Meaning that if you drop the ball from the top of the roof of a skyscraper, it is likely to bounce significantly higher. It goes up and down, back and forth until it finds a bottom. So 2 questions we are looking for the answer for in tomorrow's activities. Number 1, are we going to see a rotation from last week's winners into technology and growth? And if that is the case, then the rebound is sustainable for a few days at least. Number 2, was this a one-day wonder because we had 4 to 5 days worth of rebound rally happening in one day? Is this a rip too short? The answer is tomorrow. Not just from a technical perspective, but also from a macro perspective, because we will receive important macro data tomorrow. Moving on to the sector's performance for the day. Leading the pack at number 1 and capturing the gold medal, consumer cyclicals. At number 2, capturing the silver, technology. And at number 3, for the bronze, communication services. Only one sector managed to close in the red with declines, and that is energy. But we saw underperformance from the so-called inflationary trade. Energy, industrials, financials, materials. And we saw the laggards from last week leading the action today. And once again, the question is it sustainable or just the technicals working their course, profit-taking in the inflationary trade, meanwhile fixing some of the oversold conditions in the deflationary trade, and then reverting back to what we did the last couple of weeks? We do need more information to answer this question, because once again it goes to the core of the problem: inflation expectations, and that is what is moving the 10-year Treasury yield. Today it retreated. Is it going to continue to decline, or was this just a one-day wonder? To answer this question, we need to cover the futures market to see whether inflation expectations are retreating by declines of commodity prices or not. And for that, moving on to the futures market performance today. We saw declines here for crude oil, about 2% for the WTI, and 1.5% for the Brent. So modest retreat here for crude oil. What about softs? Lumber, one of the major contributors for inflation expectations, is actually rallying higher. Likewise, we saw gains for coffee futures and cocoa. But the laggards of the day in softs futures led by cotton, sugar, and OJ. Big declines for cotton futures. What about metals? The concern here is with copper and platinum. Those two are the major contributors for the rise of inflation expectations. So let's see how they did. Big gains for platinum futures. Meanwhile, a retreat of about 2% or so for copper futures. We also saw declines for palladium futures. Meanwhile, gains for the laggards, gold and silver futures. Big rebound day for gold. We saw a decline in the US dollar, and that helped gold futures rallying higher. And in theory, if we continue to see the dollar index reversing lower, that would actually help copper futures to rise higher, once again further contributing to inflation expectations. So these are the little things that you have to pay attention to. What about meats futures? Gains across the board, led by feeder cattle, lean hogs, and live cattle futures. What about grains? We saw big gains for soybean oil and wheat futures. Meanwhile, declines for canola, oats, and rough rice futures. On the other hand, corn, soybeans, and soybean meal futures were muted for the day. Oh, and by the way, before we move on, if you are interested in buying copper, please don't make this mistake and make sure that you buy your copper from a reputable outlet, because here is this poor guy, trader, buys $36 million of copper and gets painted rock instead. How do you get a refund for this one? Moving on to the big casino, the options market, and let's review the activities that took place today. The volume remains subdued overall. We're not seeing an uptick in the overall volume of options trading, but we are seeing an uptick in call options when you compare it to the last few days. Furthermore, we're starting to see big bets in certain names buying call options, for example, Tesla. And these massive bets, we're talking about millions and millions of dollars. They managed to contribute in moving certain stocks significantly higher today. But here it is, finishing at number 1, Apple, with about 900,000 contracts, about 69% of those were calls. At number 2, NEO, with about 500,000 contracts, about 71% of those were calls. Coming up at number 3, AMC, with about 350,000 contracts, about 83% of those were calls. And here is Tesla, with a little over 300,000 contracts, about 60% of those were calls. A big improvement in the put-to-call ratio when you compare it to the last few days of options trading in Tesla. And what about the interesting trades that took place in the options market today, starting with the IWM? Once again, we're seeing big bets here against the indices overall, but specifically for the IWM. And once again, I want you to pay attention here between the short-term bets, which happen to be bullish, and the long-term bets, which happen to be bearish. And the example here for the IWM, somebody's buying the 191 puts, expiration date May 21st, with expectations that the IWM will decline over 14.5% by then. And they paid about $350 a piece to enter this trade, bringing the total to about $6 million. And what about this trade for the SPY, the S&P 500? Another bearish bet, buying the 364 puts, expiration date April 1st, with expectations that the S&P 500 will decline over 6% by then. And once again, they paid $270 a piece to enter this trade, which brought the total all the way to about $4 million. Here is another interesting trade, a bullish one this time around, for the ticker MAC. This is for Masrick, and this is a real estate company. They're buying the 17 calls, expiration date April 16th, with expectations that the name will gain over 25% by then, and they paid about 80 cents a piece to enter this trade, bringing the total to about $1 million. And here is a very interesting trade with the ticker SCPL. This is for SciPlay. It's an online gaming company. And when we talk about gaming, we're talking about casinos. And somebody's not sure here where the stock is going to go, up or down, but they are betting on an explosive move to come. And they're buying both calls and puts, specifically buying the 20 calls, expiration date May 21st. With expectations that the name will climb over 18% by then. They paid about $1.20 a piece to enter this trade, bringing the total to about $1.2 million. Likewise, they bought the 15 puts, expiration date May 21st, with expectations that the name might decline over 11% by then. They paid about $1.20 a piece to enter this trade, also bringing the total to about $1.2 million. All we know that there is a very massive movement coming up for this name. They're not sure whether it's going to be up or down. They did the pricing analysis and they figured out that this structure is the best bet because there is a massive movement coming and it will be worth it to structure the trade this way. What about this trade? For the ticker ZM, Zoom got whacked severely over the last 2 weeks and now somebody's betting on a rebound by buying the 365 calls, expiration date March 12, meaning this upcoming Friday. And pay attention between short and long-term bets. They are expecting Zoom to rally over 7% by then, and they paid about $2.70 a piece to enter this trade, bringing the total to about $1.5 million. Likewise, we have a trade here for Snowflake, the ticker SNOW. Similarly, this is a short-term bet on a rebound for these beaten down technology and growth names. In this case, they're buying the 250 calls, expiration date this upcoming Friday, with expectations that Snowflake will gain over 8% by then, and they paid about $2 a piece to enter this trade, bringing the total to about $1 million. Continuing with interesting trades, what about the ticker AYX? This is for Alteryx, and once again the name was beaten severely the last few days, but it bounced about 8% today. And somebody's betting on more gains to come here by buying the 100 calls, expiration date April 16th, with expectations that the name will gain over 12.5% by then, and they paid about $3 a piece to enter this trade, bringing the total to about $1 million. And what about the trade for the ticker TSLA? This is for Tesla. Here's a bearish bet fading the rally today by buying the 625 puts expiration date this upcoming Friday. They got 3 days for this trade to work, and they are expecting that Tesla will decline at least 6% or so by Friday, and they paid about $8 a piece to buy the 625 puts, and that brought the total all the way to about $2.5 million. And here is the last trade of the day that we're covering for the ticker MRVL. This is for Marvell. And if you know me, you know that I like Marvell. And somebody is buying calls on this name. I did have calls, the 41 calls that I bought last Friday, and I closed my calls on the big pump today. But somebody's bidding for more gains to come for Marvell by buying the 48 calls, expiration date May 21st, with expectations that the name will gain over 9% by then. They paid about $2.60 a piece to enter this trade, bringing the total all the way to about $750,000. Moving on to the headlines that shape the day, starting with macro news. And you know, economists, big business, big corporations, market participants, everybody's optimistic about this so-called recovery because of the tsunami of liquidity that got thrown into the system. Vaccine optimism in the mix, and you get a perfect recipe for everybody almost to be optimistic. And I say almost because small business optimism has a lot of catching up to do. Here it is. Small business optimism rises in February, breaking a 3-month streak of failing optimism. The NFIB Optimism Index improved to 95.8 last month from 95 in January. However, this reading missed economists' expectations of 96.5. Of course, this is not a surprise that small business optimism is still lagging, considering the decimation that happened across the country for small businesses. And of course, small business optimism is improving in anticipation of the new stimmy checks. And they're crossing their fingers that the new stimmy checks will be treated as the first stimmy checks that we received, because, as the chart illustrates here, the first stimulus round actually improved credit spending among consumers. Not the second stimulus though. The 600 stimmy did not do it, because the 600 stimmy went into Robinhood accounts to gamble by buying call options. So small business are crossing their fingers here that the new stimmy will be spent in buying stuff and services in the real economy and not go into stock market gambling. More macro news. You are starting to hear a lot of smarty pants saying that the move in treasury yields is a little premature, and it is pricing inflation ahead of time, and the recovery is still not here. And here it is. The gap between nominal GDP growth and yields is set to rise to the highest level since 1966. And the rise of yields is due to 2 reasons. Number one, the anticipation of the recovery. We have the vaccines, we have a tsunami of liquidity hitting the market, and another round of 1.9 stimulus that is about to hit the system. Number two, inflation expectations, and you see yields rising higher and higher. So this gap will get narrower as we start to reopen, because GDP will start to improve as well. The problem is what happens after the initial stage of the reopening, 2 to 3 quarters of very hot economic activity, which will push GDP higher. But the problem is what happens if inflation sticks. Meanwhile, we see a reversal in GDP growth and employment creation. Well, that would be the perfect recipe for stagflation. But not everybody agrees with stagflation. They agree with the stag part of it, but they are predicting stagnation instead. And these are the smarty pants, by the way. So let's hear what they have to say. Once the big spending is behind us, we are too likely to find ourselves back in a condition of secular stagnation, in which the economy has persistent trouble maintaining full employment even with ultra-low interest rates. And this is from Paul Krugman. And he's one of those people that the White House listens to, the smarty pants. He is, of course, not taking into consideration what if inflation gets out of hand and persists along with high unemployment. That will lead to stagflation. But right now, the smarty pants are all in the camp of deflation, and they believe that the deflationary forces are still very strong. But in reality, they are very lazy bunch, because when you go back and forth with them, what are you talking about deflationary forces when we're talking about the prices of commodities? And eventually, they'll weasel their way around and they will say, oh, but the Fed. The Fed is going to continue to buy bonds, and therefore, you don't have to worry about treasury yields. I think we saw enough in the market's action the last few weeks that tell you the market could give a rat's ass about the bonds purchasing program. All of what they're doing is temporary band-aid to push yields lower. But so long as we continue to see inflation expectations rising higher, yields will continue to go higher and higher and higher. But once again, the smarty pants are not agreeing with this outlook at all. But at least they're seeing that perhaps all of this stimulation of the economy is not sustainable. Will stagnation follow the Biden boom? The relief bill is done, infrastructure may be harder, says Paul Krugman. Economists have noticed the good news. Forecasters surveyed by Bloomberg predict 5.5% growth this year, the highest rate since 1990s. I think they're being conservative. So does Goldman Sachs, which expects 7.7% growth, something we haven't seen since 1984. But then what? I am very optimistic about economic prospects for the next year or two. Beyond that, however, we are going to need another big policy initiative to keep the good times rolling. And once the big spending is behind us, we are all too likely to find ourselves back in a condition of secular stagnation, an old concept recently revived by Larry Summers. I know it is an obscure piece of jargon, but what it means is a condition in which the economy has persistent trouble maintaining full employment, even with ultra-low interest rates. An economy subject to secular stagnation will still have occasional good times, but policymakers will find it difficult to offset bad news, like the bursting of a financial bubble. Very, very important take here from Krugman. And financial markets are signaling that they are expecting a return to underperformance once the Biden boom is behind us. These days, interest rates are in effect a barometer of economic optimism, and these rates have in fact risen as the rescue plan has moved toward the finish line. But the rise has been modest, comparable to the taper tantrum of 2013, and it is minor compared with some interest rate surges of the 1990s. Mr. Krugman, wait, because the movie hasn't finished yet. The smarty pants like Krugman are saying that all of this spending is good for now, but we have persistent problems, and don't worry about inflation whatsoever. Inflation is not a problem at all, even though the Federal Reserve wants their cake and eat it too. They want inflation to rise higher because they believe that inflation going higher will recover the employment picture. Yet somehow the same smarty pants believe that inflation will just go down magically and everything is going to be hunky-dory. And even those who don't think that things will be hunky-dory in the long term, like Paul Krugman, they believe that inflation is not a problem. We don't even need to mention inflation at all, because the deflationary forces are so strong. And my question is to Mr. Krugman, what do you need to sustain the recovery of employment? Because you're asking the question, what happens if unemployment persists and we move to stagnation once again. Here it is, wait for it, because these mad scientists will lead us to stagflation, not stagnation. Here is the solution from Paul Krugman. The answer is actually obvious. A large program of public investment paid for by largely with borrowing, although with a case for new taxes too, if it is really big. Such a program would do double duty. Macroeconomics aside, we need to spend a lot to rebuild our crumbling infrastructure, fight climate change, and more. They're gonna explode this economy. These geniuses, I'm telling you. And public investment can be a major source of jobs and growth, helping to pull us out of the stagnation trap. Are you kidding me? More spending, more gasoline into the fire will magically take us out of stagnation and will continue to recover jobs creation. Throw more money at the problem, and inflation is not even a question. They're not even paying attention to inflation. What inflation? What are you talking about? We have a stagnation problem, according to Mr. Krugman. And once again, confront one of those smarty pants and sit down with them for about 5 minutes or so. If I have Mr. Krugman with me for 5 minutes, I will ask him the question. You think that stagnation is the problem here, even with all of the spending that we're doing right now? And your solution is more spending? And how does inflation fits in the picture? Or is inflation just something we can press Control Alt Delete and just get rid of out of the economy? Because here is the reality. More spending is not going to help this economy. It will not help job creation to recover, because job creation is tied to the recovery from the virus. We talk about hospitality, leisure, etc. And the other part is the big technology firms and other firms figured out during the pandemic that they can do more with less. So they don't need employees anymore. Throwing more money into the economy is not going to solve this problem. Throwing more money will do this. Here is the inventories to sales ratio for lumber and other construction materials. And we are reading the lowest reading since 2008, suggesting that the demand is so hot but there is no supply, meaning that we are about to see a restocking boom in lumber, further pushing prices higher and higher. And of course, the Federal Reserve, they're not addressing the problem from its core, saying that, look, inflation is higher, we understand that, and we will do and take certain remedies, actual remedies, to make sure that inflation is not going to go out of whack. No, they're not going to do that. Instead, they will just assure us that they got the tools. We got the tools to deal with high inflation if we reach there. This is the same guy, by the way, who told us that he doesn't even need a formula to figure out where inflation should be. He is just gonna eyeball the formula. And of course, behind the scene, the remedy is manipulate, distort, and deceive. And here it is. Yield curve control is already in play. The Fed is on its largest buying spree of treasuries since June 2020. $95 billion in the last 4 weeks. 90% of all were longer duration bonds. Why do you think they're buying longer duration bonds instead of the regular shorter duration? And the reason is they are trying to manipulate yields lower, specifically for the 10-year Treasury yield, because they know that the algos are pinned to watch the 10-year Treasury yield and selling off technology and the NASDAQ according to the pops in the 10-year Treasury yield. So once again, don't address the problem from its core. Just continue to deceive and manipulate, and the market, by the way, is not very receptive to these manipulation efforts. $95 billion was spent by the Federal Reserve attempting to manipulate the 10-year Treasury yield lower, and so far they've been failing. Isn't it cheaper to honestly address the problem rather than manipulate, deceive, and distort? Moving on to market sentiment news. And of course, we heard from David Tepper yesterday attempting to talk down yields. Of course, the Federal Reserve has been on a propaganda tour for the last 2 weeks, and they have failed to talk yields down. So now they're unleashing their allies from the hedge funds world to do the job for them. And Tepper failed yesterday. What actually worked to push yields lower today is the free market of traders and investors buying the dip in bonds and in the NASDAQ. But here's another attempt from the Fed's allies to manipulate and talk yields down. PIMCO seems to more or less agree. The extent of the bond market sell-off in early 2021 suggests inflation expectations may have run too far, too fast. And by the way, how is the contrast between the performance of the inflationary names versus the Nasdaq and growth names impacting the overall picture in markets? Here it is. Nasdaq 100 has not diverged this much from the Dow since 1993. The split market activity on display is another manifestation of the rotation underway as investors switch into shares of companies whose fortunes are closely tied to the economic cycle that has been painful for high growth, high valuation tech shares that become less appealing amid bond market turbulence that has sent yields on 10-year treasuries to 1.61%. And here you see that the Dow outperforming the Nasdaq significantly. This is what we call a split market, and this is one of the biggest split markets in history. And if you study history, you know that split markets are not necessarily bullish, and they are usually followed by a massive correction overall in the markets. But for now, value investing is making a comeback. Value investing gains 100 billion and wipes out pandemic losses. And here it is, another very important indicator for the Nasdaq and all of these mania names. The Russell 1000 growth versus value, relative price to book. This is the performance. Last time we saw this massive rollover and the migration from growth to value, that was the top of the dot-com bubble. So once again, all of the indicators are right in front of you, but don't expect the donkeys to get the message. Today, they went all in, Naruto style, putting their blindfold on, heads first, buying the dip. For now, they have the technicals to support them because we are in very oversold conditions, both in the Nasdaq, growth names, and bonds. So the rebound could last for a little while, but the long-term picture is changing in a very significant way. This is the first time in about 2 decades where we're seeing value investing outperforming growth investing. And here is a tweet I issued today. ARK Invest versus Berkshire Hathaway. Berkshire in red, ARK Invest in blue. Berkshire Hathaway's performance year to date is up about 15%. ARK Invest, on the other hand, is down 2.5%. When was the last time when we saw Berkshire Hathaway outperforming the mania funds, specifically during the dot-com bubble of 2000? Those of you who remember, we had all of these technology funds, the dot-com funds, who are the equivalent of ARK Invest today, and they were outperforming the market significantly, up 300, 400, 600% in certain cases. And everybody made fun of Berkshire Hathaway, saying that the dinosaur-style investing of Buffett and Munger is dying, and there is a new wave, the young generation, who are appreciating the dot-com names, and they're seeing the future, yada, yada, yada. And what happened next? All of these technology/internet funds that were trading in mania levels came down crashing, and they lost 60, 70, 80% of their value. Some even went bankrupt after the crash of the dot-com bubble. But before the crash of 2000, we started to see a very important phenomenon of Berkshire Hathaway starting to outperform these technology funds. That was the first signal that the bubble is about to pop imminently, and Berkshire Hathaway's style of investing that outlasted decades and decades of those fund managers who came and go is about to make a comeback. And indeed it did. Berkshire Hathaway outperformed and thrived during the crash of the dot-com bubble and beyond for years and years to come. And this is exactly what we will see with ARK Invest. But here is the leader of ARK Invest, Tesla witch Cathie Wood. ARK Invest CEO Cathie Wood on retail versus institutional investors. The retail investor has seen the future. They know the world is changing, said Cathie Wood. And of course, the retail crowd adores Mama Cathie, not knowing that Mama Cathie is about to take them to the slaughterhouse. Because when it comes to investing, there are certain principles that will always be here to stay. Fundamentals. Either you have them or not. Those who are investing on the merit of attempting to foresee the future are 9 out of 10 times wrong, because go back to 1999 once again. Matter of fact, the entirety of the dot-com bubble. Those who tried to invest based on the future, and we are trying to pick winners in the future, overdone it and took these names into mania territory in terms of valuation. 9 out of 10 of these names ended up failing. Only very few of them made it. And even those who made it, the likes of Qualcomm, Cisco, Intel, etc., never recovered the highs of the dot-com bubble for over a decade. Some of them still haven't recovered the dot-com peaks in the case of Cisco. So their bet that Qualcomm is the future, Cisco is the future, that was actually right. But the pricing of the stock was wrong. And those who bought at the top got slaughtered and never recovered their money. So this so-called future-based investing works as a pyramid scheme where those who are entered early in the trade reap all the benefits and those who chase the move end up getting slaughtered. Unlike value/fundamentals investing, which keeps growing and growing steadily, whether you are an early entrant or a later one. And of course, Mama Kathy likes to baby talk to the retail trader along with other predators from Silicon Valley, the likes of Chamath, Predatoria, and the rest. And the reason why they're baby talking to the retail investors, oh, you're so smart. Oh, the young generation knows everything. The young generation of investors are beating Wall Street and they know how to do research. And they're picking winner stocks. And they're not just creating another cycle of boom and bust via creating a stock market mania. They're not going to tell you that, and the reason is they're all predators. This mania from retail investors make them richer. This is why these predators love when retail traders get involved in the markets, because they know the retail traders, unfortunately, regardless of how far we've become, when we talk about resources and knowledge, we still do the same dumb mistakes that ties back all the way to human psychology of FOMO, chasing the lottery ticket, etc., etc. And we end up creating another cycle of boom and bust where we, the retail investors, get slaughtered at the end. Meanwhile, the insiders, the predators, they reap all the benefits. And to illustrate that for you, here is your favorite segment, Big Dumpers. Starting with Zoom, we have Carl Eichenbach of Zoom dumping over $12.8 million. And rumor has it that Mr. Eichenbach will use some of the money to buy a Maybach. And here is Daniel Scheinman, and he is dumping $325 million worth of shares of Zoom. What about Jonathan Chadwick dumping $53 million worth of Zoom shares? Salute. Moving on to Teladoc. CEO Jason Gorvick dumping $13 million worth of shares. What about Virgin Galactic? Its biggest cheerleader, Mr. Chamath Predatoria, dumping over $200 million worth of shares. Moving on to Workday. And billionaire David Duffield dumping $56 million worth of shares. What about MicroStrategy? You know, the CEO lost his mind and he's going all in Naruto style, blindfold on, heads first, buying Bitcoin, pretty much turning his own company into a Bitcoin bid. And some of the executives are not liking it and they're jumping the ship to get some of that worthless fiat money that the CEO is buying Bitcoin to fight. But here it is, MicroStrategy executives are dumping shares. What about Stephen Graham dumping $2 million? And I'm not sure if this is the right picture, but I googled Stephen Graham of MicroStrategy on Google, and this is what I got. But I'm not sure who this guy is. Anyways, what about Fang Li? He dumped $3 million. And then we have Carl Rickerstein dumping about $7 million worth of MicroStrategy shares. And what about Microsoft's CEO Satya Nadella dumping over $65 million worth of shares? Good for you, Mr. Nadella. Now use the money wisely and don't blow it on hookers on OnlyFans. Moving on to Freeport-McMoRan. Yes, one of my top holdings. And they're dumping shares too. Here is Director Gerald Ford dumping over $8 million worth of shares. Oh, wait a minute. We got the wrong picture here. Here is the real one. Doesn't look so different. Anyways, moving on to Discovery. You know, Discovery stock has been going parabolic. Bananas. Over the so-called Discovery Plus streaming optimism. And back in December, in this channel, we covered the chart of Discovery and I told you that this stock is about to explode higher due to the Discovery Plus optimism. But the genius that I am, I forgot to buy the stock. I thought I would get another dip, and what do you know, the stock blasted higher without me. But perhaps the party is already over, because here we have Executive J.B. Peretti, whatever the hell that is, dumping $30 million worth of shares. And since I called you pretty, Mr. whatever the hell your name is, how about you give us 100K out of that cool 30 million you just cashed? I'll give you my OnlyFans link. What about Nvidia? CEO Jensen Huang dumping $24 million worth of stock. And here we have Zillow, Rich Barton, dumping $22 million worth of shares before the recent correction. The rats are jumping the ship. What about Square? With the CEO Jack Bin Laden dumping over $50 million worth of shares. And then we have Etsy, CEO Josh Silverman dumping $12 million worth of shares. And here's PayPal. Aaron Kramer dumping over $10.5 million. And then we have Sripada Shivananda. That's a cool name. He's dumping $11 million. And then we have Louise Pentland of PayPal dumping about $20 million worth of shares. And lastly, we have John Rainey. And of course, it's raining on John Rainey, raining cash, that is, because he dumped $19 million. But rest assured, not everybody's dumping here. We have a buyer for Wayfair, Andrew Cumin, buying $13.6 million worth of Wayfair shares. And of course, Wayfair is actually a value name, believe it or not, and it was one of my top holdings. I bought it during the March bottom of last year for about $25 a piece. In the genius that I am, I sold it in July because I thought it went too high. And you can only take a look at the chart and see how high Wayfair went after I sold it. But there is no reason to cry over spilled milk. Speaking of milk, let's move on to corporate-specific news, starting with the souffle, Tesla. And we know that the souffle had a pretty decent day today, rebounding by about 20%, nearly wiping out 5 straight days of selling. But regardless of that, the hype of the souffle is being exposed by the day. And perhaps the heydays of the souffle are coming to an end. Number one, yields are rising higher and the future bro kind of companies are not working anymore. Tesla is the king of the future bro. We also have rising competition all over the place. VW, Ford, GM, you name it, in addition to the Chinese brands. On top of that, we have a commodities super cycle where the prices of lithium, cobalt, nickel are rising significantly higher, meaning the margins are about to get crushed. And you might say, oh, but that's going to hurt all of them. All of the auto manufacturers involved in the EV play will get hurt. And you are right, but the souffle will get hurt the most, and the reason is because the souffle stock is the most overvalued EV stock. Furthermore, here it is. While Tesla's official numbers say that the production capacity in their factories in Fremont and Shanghai can produce about 1 million cars. But here is the truth. Of course, Reverend Elon is a master of deception. And he can promise you all kind of stuff. Robo-taxis, chips, software, false information, doesn't matter. Because here is what matters. Facts. Tesla monthly China sales, despite massive and continual price cutting. November 2020, 21,604 cars. December 2020, 25,500 cars. January 2021, 15,484 cars. February 2021, 18,318 cars. All in all, the production capacity, 37,500. Not only they're downtrending in China in terms of sales, but we also have a massive bullshit hype/fraud problem here. Moving on to Boeing, aka the flying coffin. We had a lot of bad news regarding the flying coffin, but perhaps the worst is behind us. And the flying coffin stock is actually a buy now, because here it is. Boeing booked 82 new gross orders in February and only 51 jet orders canceled. And this is a massive improvement from the last numbers. With that being said, you cannot pay me to travel on the flying coffin. Moving on to the heat map analysis, and let's see what we got today. The obvious story is the massive bounce in technology and momentum/growth names. Massive outperformance across the board, specifically in the beaten down names, semiconductor names, software names, all rebounding big, along with big tech names such as Apple, Microsoft, Facebook, Amazon, even though Facebook and Google were not really touched by the correction during the last 2 weeks. They've been outperforming and they continue to outperform even with the rebound that we saw in high tech, high momentum names. What's underperforming in the technology names? The old school names that have been outperforming while the technology sector has been selling. We're talking about Cisco, we're talking about Oracle, we're talking about IBM. IBM down about 0.5%, meanwhile Cisco and Oracle closing in the green, but yet lagging the massive gains that we saw in the more growthy names of the technology sector. But the big question here is, did we just see a rotation from energy, industrials, financials, materials to the lagging names, the beaten up names in technology, biotech, etc.? That is the $1 million question here, because if this is just an algorithmic bounce from oversold conditions, then the rebound is not sustainable. But if we are seeing profit taking from the outperformers and buying the dip in the beaten down technology names, then perhaps there is some sustainability in the rebound here. To answer this question, we need to revisit the themes analysis, starting with the nostalgia names / the reopening stocks. Pain across the board, not significant pain. We're not seeing a mass exodus from these names into technology. We saw certain names outperforming, such as Royal Caribbean, AMC, Diageo, Coty, but notable weakness here for a trade that was so hot the last couple of weeks. What about the high inflation stocks or the inflationary trade? Declines across the board? Modest declines. We're seeing some names still outperforming. Alcoa up another 5% or so today alone. So once again, we don't have an answer here whether this was an algorithmic bounce or a rotation from the inflationary trade into the deflationary trade in the beaten down technology and growth names. Of course, over the weekend, I told you that I would love to see a sell-off in these names, profit taking, because the dip is to buy in these names. But don't be a donkey. Let the process take its place. There is a process of a rebound. In the beaten down technology names, that could, keyword could, come hand in hand with a rotation out of the inflationary trade. But all in all, the long-term outlook is that the inflationary trade will continue to outperform. So the dips here are to buy, but let the process take its course. What about the deflationary trade? Outperformance across the board here, massive gains, whether we're talking about Okta, Zoom, Nvidia, Square, Peloton, Tesla, DocuSign, all up massively today. Once again, the dip is to buy in the inflationary trade and the pop is too short for the deflationary trade. But let the rebound take its course. If you saw the pop in the morning today and you started buying put options, you probably got slaughtered today because you went Naruto style, heads first, ask questions later. Let the process take its place. This could be a one-day wonder, but you don't know that. So wait till you spot a sign of a reversal. But the long-term outlook here did not change for us. The inflationary trade will continue to outperform the deflationary trade. Moving on to the charts analysis, starting with the SPY 15 minutes chart. Let's see what's going on here. Right away, you're seeing that we gapped higher and we recaptured the resistance, now support level of 386. The challenge here for the SPY to maintain that support of 386 and continue to march higher. The problem is, if this is a real rotation from winners to losers, then yes, the technology names are a big component of the S&P 500, but so do financials, energy, industrials, etc. So you could see the SPY actually trending lower or at least underperforming the Nasdaq in the case that the bounce we saw today is sustainable. Now, we have a wedge-ish kind of formation here and we fell back inside the wedge by the closing. And the challenge here is you don't want to see a break lower. Remember, all things into perspective. We're talking about a 15 minutes chart here. We're not talking about weekly or monthly. So the significance here is very minimal. So we have to zoom out and talk about the daily chart of the continuous contract of the SPY. What do we see here? All in all, no damage whatsoever done for the SPY. The so-called correction barely touched the SPY. We saw a breach of the support level of 3,862 and then the yellow trend line. And what I said back then is, if you fail to recapture the trend line and the support level of 3,862, then it becomes inevitable that the SPY will go down to revisit 3,600. What did we see the last few days? We are at significant resistance, and the momentum indicators are saying that there is a correction imminent in the S&P 500 because we've never made any correction regarding momentum since the March bottom. It's been one hell of a ride higher, but take a look at the RSI, for example. We still have negative divergence. And from a MACD perspective, we are due for a negative crossing and creating serious red impressions on the histogram, meaning that the weekly chart outlook for the SPY is not good. And therefore, I'm saying differentiate between the short-term outlook versus the long-term outlook. In the short term, we can go back and forth and even rally for a little bit. But at the end of the day, when you look at components of the SPY, energy, financials, the so-called inflationary trade, even these names, the reopening names, all got out of whack from a technical perspective and valuation perspective, and they need a correction of their own. So once again, the weekly chart is suggesting weakness for the SPY, and you have to keep your eyes on the big picture. Trade for the short term, but don't forget about the long term picture. Moving on to the Qs, 15 minutes perspective. What do we see here? A massive gap higher. The work was done overnight. We saw retail traders and market participants in general picking up the steam of the rally, buying call options, buying the dip in certain names. All in all, the Qs managed to surpass two important levels of support. Number one, the 303.35. Number two, 308.5. But the big kahuna is 313. And I issued a tweet saying that the real test here for this so-called bounce has to be recapturing 313. The Qs had every tailwind to capture 313 today. Whether we're talking about the retreat in treasury yields, whether we're talking about the massive rebound in Tesla, a huge component of the Qs, yet somehow they reversed and they did not close above 313. Am I making a big deal out of it? Not really, but it is notable. Can you gap over it once again overnight? Yes, you can, and that would be the way to sustain the so-called bounce. But if the futures trade flat or negative and then we reopen, what I will be watching for is how will the Qs react once reaching 313 again. So now you have an important level to watch, 313. If the Qs continue to decline without even attempting to recapture 313, and this is a very ominous signal. We just had a one-day bounce, a dead cat bounce, whatever you want to call it. But 313 is the real test for the sustainability of this bounce. Moving on to the daily chart of the continuous contract of the Qs. We're going back and forth with massive volatility both ways. And the challenge here for the bulls to recapture the purple trend line. That would signal a huge recovery. The challenge for the bears is to continue to pull back the Qs all the way to revisit the trend line in yellow, because the trend line in yellow is the major trend line. It will coincide with about 17.5% correction from the top, and that would be a very, very solid support for the Nasdaq. The problem from a massive bounce, just like we saw today, is that you get to correct the oversold positions and then some very, very rapidly. The bottoming process is keyword process. You don't get to remove all the oversold conditions right away. You take time and you build up a bottom, a solid bottom, and then start to rally once again. But these massive spikes higher indicate that the bottom is not here yet. We have more volatility to look forward to. Remember, last week we had a massive bounce, and that only lasted a day. So once again, those who are looking for a solid bottom here, for the Nasdaq, you're looking for a process, not a V-shaped recovery. That's not going to happen anymore. What about the NDX, the daily chart? And let's take a look at certain retracement levels here from the Fibonacci perspective. We bounced all the way to the second Fibonacci level in green and we started retreating. Now, in my opinion, if the rebound is sustainable and will be followed up by more buying, we could reach the Fibonacci retracement level of about 13,251 before reversing lower. That is assuming that today's action will be followed up by a confirmation of more buying. Could it be a one-day wonder? Yes, it could be. And the Fibonacci retracement levels are saying that we have already reached a resistance level and we could trade lower from this point on, specifically given the velocity of the rebound. And once again, the weekly outlook for the Nasdaq tells a different story. You can rebound all you want, but at the end of the day, we are overextended. We are due for a correction, a bigger one. And my opinion is that we will dive lower or perhaps settle at the levels between 11,191 and 12,236, which will be the next Fibonacci level of retracement. Take a look at the MACD curling downward. The RSI not oversold at all from a weekly perspective, suggesting that the correction just started. You can bounce in a daily perspective, but once again, the damage from the big picture in the weekly chart is already done. Moving on to the IWM 15 minutes chart, gapping higher and consolidating where? At the bottom of the trend line of the channel. Once again, I'm not drawing these trend lines for you randomly. The algos are also respecting them. So what do we see here for the IWM? Big rebound, and it could be sustainable assuming that we recapture the channel once again. To show you that, I have to zoom out to the daily chart of the IWM. Once again, trading above the important support level of 218. When you take a look at the Nasdaq, for example, you can see damage. The IWM, you don't see damage, but you see damage in momentum in terms of breaking the trend in the RSI and making red impressions in the histogram of the MACD, signaling that it is very hard to push higher here for the IWM without a meaningful pullback. And that pullback should take us all the way down to 196.5, and then we will see solid support and a case to build a bottom. But for now, the IWM is very, very extended and it is due for a correction of its own. What about the Dixie? Big reversal here for the dollar index without reaching 93. You know from a technical perspective that in any chart, reversing before hitting an important target, in this case it was the resistance level of 93, is a very, very bad signal. So the assumption here is that the sell-off in the Nasdaq is over for now, and there is no need to raise all of that cash, pushing the dollar index lower. Furthermore, we have a new round of stimmy coming up that would add pressure on the US dollar to dive lower, and we closed below the support level of 92. And if that is the case, that the dollar reversed and it will continue to downtrend, that would be good news for what? For gold. Here is gold almost reaching my target of 1675 and bouncing higher. And the question is similar to the question with the Nasdaq. Is the bounce sustainable? Well, when it comes to gold, the answer is a lot easier because you have the chart of the US dollar to look to. If the dollar continues to dive lower, then gold will continue to rise higher and higher. You need a confirmation. You saw a reversal in the US dollar, you're looking for a confirmation tomorrow, and that would be the green light for gold to rally higher. When it comes to the Nasdaq, the answer is a lot trickier because you have a lot of things to look forward to beside the US dollar to determine whether the bounce in the Nasdaq is sustainable or not, such as if we have a rotation going on from winners to losers, and treasury yields and the impact of upcoming economic data on treasury yields. Now the question is, can gold rally even though Bitcoin is going higher? The answer is yes. If the dollar continues to dive lower and we see a reversal, a confirmation of that reversal, then gold should go higher, even if Bitcoin continues to rise higher. Here is the chart of Bitcoin. Once again, higher lows, higher highs, and we have a cross imminent in the MACD to start creating green impressions in the histogram, suggesting an uptick in momentum for Bitcoin, meaning that Bitcoin should rise higher and make higher highs. That is the assumption. Of course, Bitcoin is susceptible to its own volatility, but the technicals suggest more upside for Bitcoin. And what about treasury yields? We saw a big decline today. Lots of reasons behind that decline. The Fed purchasing overnight, the 3-year auction, the oversold conditions in the NASDAQ and in the TLT, which we will look at in a second. But before the bulls in the stock market start rejoicing, this is not what you wanted to see. What you wanted to see is that treasury yields go impulsively higher and then reverse, and that would be the top at least for a few months. This pullback is only paving the way for more upside, because when you pull back in small increments, you're taking a lot of air out of the bubble, technically speaking, and overbought conditions become not so overbought. It's the same argument that you wanted to see in the NASDAQ if you are actually a bull. You wanted to see a massive down day, the NASDAQ down 4-5%, and then reversing higher, closing off the lows, because that would be a signal for a solid bottom. What you don't want to see as a market bull is a day like we saw today, of a massive rebound higher, because that is not sustainable. It fixes the oversold conditions too quickly. Enough said. Moving on to the TLT. Here's a daily chart. And what does this look like to you? Number one, we have a bull flag formation, a bottoming formation that is playing out in the TLT. Number two, we have severe oversold conditions in the RSI. Number three, we have an imminent crossover in the MACD indicator, signaling that perhaps bonds in the TLT's case could actually rise higher, pushing yields lower. But we have a massive resistance to look forward to in the level of 143. So perhaps yields can go down to 1.5 and then bounce higher. And if we are reading the tea leaves and putting the pieces of the puzzle all together, let's say that we open higher tomorrow in the indices, specifically the NASDAQ. The TLT is higher, TNX yields lower, and then we hit the magic numbers. The TLT faces resistance, the TNX catches support from 1.5 or whatever that level is, and then the NDX, the NASDAQ, faces resistance and reverses lower. I am just trying to piece the puzzle for you. Moving on to the VIX. The VIX closing below 25, which is not what you want to see if you are positive or bullish on volatility. But once again, we are still seeing this cup and handle formation that is supposed to play to the upside. When does this formation go out of the window? If we make lower lows, breaching the level of 20. Moving on to Apple, 15 minutes chart. The challenge for Apple here was to recapture the 120 support, and it did that successfully. Remember what I say, as Apple go, so will the NASDAQ. Yesterday, Apple was down while the NASDAQ was trading in the green, and that was your leading indicator that the NASDAQ is about to flush lower. Now we have Apple closing in the green, capturing 120 once again, and you see the NASDAQ surging higher. But how sustainable is this reversal in Apple? To answer that question, we are visiting the daily chart. If you are bullish on the NASDAQ and you bought the dip today, I got some good news for you, because Apple has room to recapture 125 and even go all the way closer to 131. I don't think that I will manage to close above 131 because there is a massive reversal candle here, and the top of that reversal candle happens to be around 128. So Apple could continue to rebound higher, surpassing 125, going all the way to 128, and then facing some resistance. The problem is, I gave you the good news, here's the bad news. Apple, from a monthly perspective, is it oversold? Not at all. Is it curling downward, hinting and implying that there is a massive correction about to hit? Yes, it is. Meaning, on a day-to-day perspective, Apple could bounce higher. But the long-term outlook is suggesting here that we have reached the top and we are due for a massive correction. And that will take Apple perhaps below 100. So once again, differentiate between the short-term outlook and the long-term outlook. And the case is similar here when we talk about Tesla. Tesla rebounding massively, over 20% today, at least during the highs of the session. We saw significant oversold conditions in the RSI. I'm highlighting the oversold conditions for a reason, to illustrate for you that today's bounce is not healthy for Tesla, because you managed to repair the oversold conditions and then some. You're down at a reading of about 25 and you reach all the way to 45 almost. That is a massive correction of the oversold conditions, meaning that now you are ripe again for another round of downward action before you become oversold once again. This is exactly what I mean when I say that today's action in terms of the bounce was not healthy at all. It is not sustainable because it has done what was supposed to be done in the course of 4-5 days in a single day. Now understand that Tesla could go higher because the MACD perspective is suggesting from a daily outlook that Tesla should start to gather more momentum. And if we use the Fibonacci retracement levels on the daily chart to figure out how high Tesla can go, today Tesla rallied higher all the way to the Fibonacci level of 678 and then closed slightly below that. Could it go higher? Yes, but the third Fibonacci retracement level is very, very difficult to break above. That is between 678 and 721, meaning that today's bounce could be followed up by another day of 3, 4, maybe 5% gains, but that will be about it. This is at least what the Fibonacci retracement levels are telling us, that Tesla has room to go all the way to 720, 721, but it will be very, very overextended then, and it will reverse lower. Now, the big picture. Weekly chart, and here is the contrast for you. Once again, we just started the correction, crossing the MACD, creating negative impressions in the histogram. Not oversold at all from a weekly perspective, meaning more room to the downside. On a daily perspective, you were oversold. You're not oversold anymore, even in the daily chart, because the name bounced over 20% today alone. So what are we looking for here? From a weekly perspective, the bounce could continue higher all the way to the levels of about 708. The daily says 712, the weekly says 708. It doesn't matter. It is within the area of 700. You can go all the way there, but you will face resistance once again and then turn lower. And if you do break the level of 600 or my number 599, it doesn't matter, just 1 point difference. If you do break that a second time, that would be the confirmation that Tesla will slip all the way down to settle between the levels of 400 and 500. So in summary, what does that mean for you as a trader? If you did buy the dip in Tesla today, ride the wave all the way to 700, 720, but it's not going to go higher than that easily. So your exit strategy should be around 700, 710 at the most, and then you watch out for a reversal. And if we struggle to break above 710, 720, then that would be an opportunity to short all the way back to the level of 600. If 600 doesn't work and we breach 600 once again, then the floodgates will open. So as a trader, these are the tactics that you have to prepare for. And now, moving on to conclude this video. What do we have tomorrow? Very, very important day from a macro perspective. The Consumer Price Index and the core CPI. Now, I assure you that the cooks are working overnight to give us a number that inflation is not rising in any concerning way. And perhaps the number leaked ahead of time, and therefore we saw a rally in the markets today. Regardless, it will be very difficult to fake a number, specifically when we had energy prices, crude oil prices, sustaining levels over 60 for weeks now. Meaning that if the number is not cooked, or we get a real number indicating a pickup in inflation, then you will see yields surging higher once again. And algos are not going to like yields going higher. Meaning that what we saw in the Nasdaq today is a dead cat bounce. It was a one-day wonder, and we will reverse and continue to slide lower. That is assuming that the data we receive tomorrow will suggest higher inflation. And here's the last thing I want to leave you with. Just to illustrate for you that cooking the books regarding inflation will be a very, very difficult task, and the market will look through it. The small business actual price changes versus core CPI. And as you can see, high correlation. And now we have the NFIB actual price changes surging higher. Meanwhile, the core CPI is still lagging, suggesting the core CPI will start to pick up higher. It is inevitable. And if core CPI, the formula that the Federal Reserve uses to measure inflation, start to go higher, then the whole bullshit narrative of all yields are just rising for the right reasons and inflation is not a concern, that goes down the toilet. And tomorrow will be the first indicator whether CPI is going to start to surge higher following the rationale of this chart or not. And if it does, then yields will rise higher. And what we saw today in the NASDAQ is indeed a sucker's rally, dead cat bounce rally, whatever you want to call it. So a few things that I'm looking for in tomorrow's action. Number one, the macro data, specifically core CPI. I'm watching the dollar index. I'm watching whether we have a rotation from winners to losers. And I am watching how Tesla will react going into its retracement levels. That's all I got for you today, and I'll talk to you again tomorrow.